All right, so just for now, remember highest and best use. What does that mean? It only relates to non-financial assets where we find the best way of generating the most future economic benefits, and that is then the fair value for that non-financial asset. All right, let's move on to slide number 11. The most advantageous market versus the principal market. I would go and contrast these two, versus. Okay, because you get the most advantageous market, all right, and then you get the principal market. Now the question is, when we determine fair value, and forget about non-financial assets now, okay, think about in general, when we determine fair value, which of these two do you think IFRS 13 is going to prescribe? The most advantageous market or the principal market? Now, IFRS 13 says that fair value should be determined with reference primarily to the principal market. Whereas, if that is not possible, if there is no such market, we look at the most advantageous market. All right. Now, that's why it's important for us to understand the difference between the two. Let's look at the first one. The most advantageous market is the market that maximizes the amount that would be received to sell the asset, or minimizes the amount that would be paid to transfer the liability after taking into account transaction costs and transport costs. So what does this mean? This would mean the best price that we can get for our asset, or the lowest settlement price that we have to pay for our liabilities under any circumstances. So this would be, even if we could say we can do a special deal with a company that is a related party, then that is a most advantageous market. Do you agree? Whereas if you look at the principal market is the market with the greatest volume and level of activity for the asset and liability. Now, ladies and gentlemen, why do you think that this is the preferred market? Because it gives you so many transactions that, number one, you hopefully find an identical transaction, which gives you a level 1 quality fair value measurement, or you find a similar transaction which gives you a level 2 quality fair value measurement. Do you agree? So we're hoping that there are so many transactions that we can compare. So number one, the increased level of comparability is the advantage of a principal market. So when I'm determining my fair value, I primarily aim for a principal market. And only in the absence of a principal market am I going to use the most advantageous market. All right. So first prize, principal market. Second prize, most advantageous market. All right. So I think take some time, take a few minutes, read through these definitions before you look at the next chapter, and then we go on with IFRS 13. In Chapter 3, we're going to now investigate this fair value hierarchy. Now, what is this fair value hierarchy all about? It's the quality of the fair values that you obtain in the market, or if you can't get it in the market, internally. And it's those 3 levels of inputs into your calculations of fair value. Where do you source them from? That is the fair value hierarchy. So let's have a look on slide number 13. IFRS 13 seeks consistency and comparability by providing this hierarchy. Okay, the hierarchy categorizes the inputs used in valuation techniques into 3 levels. Look at that. Level 1 is the highest priority. And these are unadjusted. Look at the quality of information. They are so, these values are so usable and so relevant that they are unadjusted, quoted prices in active markets. Do you see? So what is an active market? A market where we've got that definition, a market where there's frequency and volume, do you agree, of the transaction in such a way that it provides information to the user regarding fair value of that particular asset or liability. So it's unadjusted quoted prices. The quality of that fair value is so good that you can use it as it is as an input in your fair value calculation. Then the contrast to that is level 3. Now those are the poorest inputs. Okay, the lowest priority. You do not try and source your fair value information from this category unless you really cannot find it in level 1 or level 2. Look at this, unobservable inputs. So this means there's no market for this. The information that we use to determine the fair value of this asset comes from management information. So management has done a calculation internal in this business. It's an internal calculation. Management has done that calculation, and that's the only thing that we can depend on. We don't have any observable data. What does that mean? We can't go to an independent market. So that brings me to the next point, the difference between level 1 and level 3. The independence of the inputs. All right, level 1, highly independent. Level 3, right at the bottom, not independent at all, because it's internally generated. So I can tell you now, when you've got internally generated fair value information, immediately you are playing in level 3, and your required disclosure is going to be massive versus level 1. All right, what if some inputs into your fair value are level 1 and other inputs are level 3 for one fair value that is required? Ladies and gentlemen, the standard goes worst case scenario, you are dependent on a figure that comes from level 3, so you will have to provide the disclosure requirements relating to level 3. That's how it works. So remember that, worst case scenario, the level for the entire fair value measurement is equal to the lowest level into which inputs have been categorized for the measurement process. So the standard is quite severe on this and is not going to allow you then to play in level 2 or in level 1. You're right at the bottom at level 3 because that's where some of your inputs came from. So if you got some of your inputs from level 1 and level 2, you're going to be in level 2. So what does this teach us about level 1? All of your inputs for the fair value must come out of level 1 before you can be regarded level 1 fair value measurement hierarchy and have little disclosure. All right, so I think this makes perfect sense. The more independent the information, the more it's driven by the market, the more it's observable data that cannot be internally manipulated, the lower the disclosure. And the opposite is also true. If it's internally generated data, lots of disclosure, lots of assumptions, judgments, all of those things that will have to be disclosed. Once again, the disclosure is in the notes to the financial statements, so it's additional information. It doesn't affect directly, the disclosure requirements don't affect the face of the financial statements. The fair values that you determine obviously do, because that's measurement of your assets and your liabilities. Let's move on to slide 14. What do level 1 inputs look like? And I think this is important because if you see in the question, this is how the level 1 input was determined, then you'll also know what the required disclosure is in the notes to the financial statements. Quoted prices in an active market for identical assets or liabilities. Can you see that? I would underline the word identical. And once again, we are looking for that principal market, because in the principal market, there are so many transactions that take place that we are hoping to find one that is not just similar, but identical. All right. Quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. Easy to obtain. Secondly, most reliable evidence of fair value. Definitely level 1. Those quoted prices, they are purely regarded the most reliable evidence. Look at what the standard says. Level 1 inputs are used without adjustments. All right? And then if you look at the fair value, the quoted price times the quantity held, that's your fair value. Now, an interesting thing that is mentioned in the standard, look at the bottom of slide number 14. Even if the market, the normal trading volume, is not sufficient to absorb the quantity held, remember, we are determining fair value theoretically. So if I say to you, yeah, but the market cannot absorb the number of shares that I have to sell, and therefore the price is going to be affected should I really decide to sell in the market, that's irrelevant because those consequences are not going to happen. Do you agree? Now, what's important? Look at the second one. Even if placing orders to sell the position in a single transaction might affect the quoted price. Think if you hold 200,000 ordinary shares and you want to dump them onto the market all of a sudden, what's going to happen to the price? The price is probably going to decrease. Do you agree? Because as as supply increases, demand is going to decrease and then the price falls. Do you agree? So what's important here? Those two items should be ignored. Whether the sale can be absorbed in the market, and secondly, whether such a big sale, for example, would affect the market price. We're using the quoted price in an active market unadjusted because that's how high the quality is of this independent fair value. All right, let's move on to slide 15. What do level 2 inputs look like? They are inputs other than quoted market prices included within level 1 that are still observable for the asset or liability, either directly or indirectly. So what does this mean? They must still come from the market, but they're not as high quality as level 1. Now I'll show you why. For example, quoted prices for similar assets or liabilities in active markets. So what does that mean? They're not identical, they are just similar. All right? Quoted prices for identical or similar assets or liabilities in markets that are not active. So here you can see we've got an identical asset, but this wouldn't qualify as a principal market. Do you agree? Because it's not active. And a principal market has to be an active market where there's a high volume and frequency of trading in this asset and liability. All right, so there's a qualification there, and that brings it into level 2, but still it comes from a market. Do you agree? Number 3, inputs other than quoted prices that are observable for the asset or liability. For example, interest rates. Think about when you determine the fair value of financial instrument at initial recognition. We all know that financial instruments at initial recognition should be measured at fair value, not at consideration. Do you agree? Otherwise, they're measured at cost. Now, when you determine that fair value at initial recognition, and you can determine an interest rate or a yield curve, and these things are available at commonly quoted intervals, etc., that is a level 2 market, level 2 fair value input. All right. So remember, when you determine the fair value of that debenture or the preference share that's redeemable or anything like that at initial recognition, you are going to be using that interest rate. That's a market-related interest rate. It's not for 100% identical transaction necessarily, but it still comes from a market, and then it goes into level 2. All right. Implied volatilities, credit spreads, all of that information that helps you. But what do you see about the quality of the information? It is more general. It is not so specific to this particular asset or liability. That's what is implied by it's a similar asset or liability and not an identical asset or liability. You see, so what is my prize number 1? An identical asset or liability in an active market. Do you agree? That is what I'm looking for, a quoted price for that asset or liability. Okay, then inputs that are derived principally from or corroborated by observable market data by correlation or other means. And these we call market corroborated inputs. Now people, what are we saying here? At least there's some way of checking the validity of the data. So this is like doing an analytical review, the same principle. Is there a trend that we can see in the market that confirms what our input is actually saying? Okay, is our fair value, can it be corroborated by looking at some sort of market? So can you see where we're moving? We are moving more vague, but still into a market. That's level 2 inputs. Okay, then let's look at level 3 inputs, unobservable inputs for the asset or liability. These are used to measure fair value to the extent that relevant observable inputs are not available. For example, when there is little, if any, market activity for the asset or liability at the measurement date. The best available information is used in the circumstances, for example, the entity's own internal data. Now, we're not saying that this information is bad or that it's not the right information or that it's misleading information. All that we're saying, this is not independently determined. Therefore, it's not a high quality, but we're still using it because it's the best information that's available. But what is the penalty that we're going to pay?